Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, April 26, 2023. It is 4:10 p.m. Eastern Time, and I'm starting the video. And I wanted to go ahead and start this one before Meta reported, and I'm guessing they just reported literally as I click the start button. That's fine. I'll talk on that. We say, don't the initial reaction, don't read too much into it. Let's see what, give the market a day or so to digest everything. And of course, you have the initial report. Stock will do one thing or the other, and then the conference call. Some companies give guidance, some don't. But here's Meta. I'm going to just flip over to talk on that because it looks like they must have just announced. I see the stock going up at the moment. And let's see here. There it is. There's a spike up here. It looks like it's up about 10% in after hours. So yesterday I laid out a scenario, I believe I did, and if not, I'm going to lay it out again, that we had a breakdown recently, and as I always say, take any breakdowns that occur right before a company reports earnings with a big grain of salt. Because those, earnings can override just about anything. So again, companies stocks tend to drop off in volume right before earnings. Nobody wants to take a new position. But my scenarios for Meta was one or two that you broke down recently, a few days ago, about a week ago, been drifting lower, and either a continued move down, but here it is, we're after earnings, and it's right up to that alternative scenario, which was I'd put equal odds all along, and we've hit it now. We have a primary, very nice. That's our primary bear market downtrend line off the highs back here in September. You can see, I'm trying to get my line tool going. There it is. So now we have a perfect tag of that. Just like Apple just made a perfect tag of its bear market downtrend line in after hours. Again, this may or may not show through tomorrow. We could certainly go higher. There's a this is big gap resistance. I don't think we're going to get that high, is my opinion. I think this is a great shorting up right now. Here at the bear market downtrend line and the apex. So you have the big bearish rising wedge that we just broke down from right here. Let's grab that line. There's our divergence line. So this little pop in the after hour session right as I'm starting the video simply extends the negative divergence and gives us a perfect back test of the wedge of the primary uptrend line. So breakdown back test. When you break down, sometimes you go on to hit your targets and you never look back. And sometimes you break down, you do a little snapback rally to back test the trend line or wedge from below. So, that would also hold true with QQQ and NQ, an objective short here. I'm going to get to those. This won't be a long video. I just want to do those updates. So now we're counting them down. We have Microsoft out of the way. We have Alphabet out of the way. Now we have Meta out of the way. Tesla was already first to go last week, and we know what happened with Tesla so far. And there it is. So again, this is showing after hour trades here, and that is nice resistance. And there's also some price resistance around there, but again, that's big resistance. Let me just keep this one simple. My first target on the downside for Meta is right here. Let me turn this line up a little brighter so you can see it. It's about 197 and change. That's certainly the first stop there. There's a top of a gap right here at about 169 or so. I think that's 169, but I favor at minimum a pullback to about right here, this 156-ish target. In other words, you have this big old gap right here. Bottom of the gap is a little bit below that where I have the purple line. That was big support here. And so what I see is likely a drop coming of about 32% in Meta. And so when you talk about RR, risk reward ratio, which is what you want to frame every trade in, if you shorted Meta here right now at 229, you gave a stop somewhat above, ideally on a daily close above that 240, we'll call it 246. You're talking about 7%, maybe if you give it a little room, for a daily closing basis, maybe 7-8%. And if your targets hit there, you make 32%. That's an excellent RR of about 4 to 1. Take that one all day long. And so there it is. So there's Meta at confluence resistance and after hours. But they're buying it at this moment. And and when do things start to change for me? Well, let's go back to look at Apple, for example. When you start seeing stocks like that, like Meta and Apple, APL, let's see if I can type here, go on to clearly take out their bear market downtrend lines and put them in the rearview mirror. Apple so far rallied right into that trend line, pulled back. Remember, Apple is the last, the big fangs to report. Their next, I think, Thursday after the close. And to me, that concludes earnings season. Now, it's not technically over, but that's it for me, because that's the you'll have all the fangs out of the way. Remember, the top 6 or 7, I believe it is, components of the NASDAQ 100 literally make up over half of the returns of that index. So it does not matter what the remaining 94, 95, 93 stocks do, only what these guys do, and this will conclude earnings. You have a massive bearish rising wedge, negative divergence. Nothing on my outlook has changed. And so again, it's going to be a little while before they report, but so far so good with the breakdown and the back test. So let me take it back to we're in pre-markets. I mean post-markets. I'll just leave it here. The white candles are post-market trades. So here's what happened today. This morning, or yesterday, let me just back up. We had that big support zone, sell signal triggered. We clearly broke below it yesterday. That's the chart I got out today, was the almost a perfect hit of the support I had on NQ. There's also a gap right here. We pretty much came and hit the top of this gap right here yesterday. And so that, of course, was an objective area. We were down almost 2%. It was right in front of earnings. So, of course, they're going to buy it up, and they did. That's the first target. You're usually going to get at least a reaction. And so what happened today, it carried up, and the post I got out to you this morning said, any back test, we were right there at the top of these, I have it as a support zone, which runs from about, it says on this 60-minute chart, it says 313.62, and here it says 312.49. On the daily, it's really about 312. So again, it's more of a zone. It's not a hard level because we had a few pierces down below there. And so that was an objective short, and I said if it can carried up a little bit more, which is perfectly normal. When you break down, you back test, sometimes you'll carry a little bit back within a range, especially if it's not super well defined, more of a zone. And then I said any pushback to this downtrend line would also be an objective short entry. So that's what you got. You had a nice reversal off there from that back test and the rally into the trend line. The Qs dropped about 1%. And Meta's carrying them up a little bit, giving you once again another objective short entry. So, a couple comments I replied to from yesterday and today. To me, this is nothing more. And look, it can prove to be more, certainly by tomorrow. But right now, it's nothing more than a simple breakdown and back test. So if you don't short a breakdown and you're looking to get short and you missed it or whatever, wanted to hold off to, let's say, Alphabet and Microsoft were out of the way, and then you were given another opportunity today to short at even a better price, because that's a back test on that little trend line there. And so here we are. So we're right there now. It's not, I have to say this, it's still anybody's game because we're back right on the bottom of the range. We closed today. If you turn off the lines, if I click off the and just show you a regular session, you can see we ran up, hit the trend line that I gave you this morning, pull back, and so close a little bit below it. It's really at this point in time, the next sell signal, that was still an objective short entry, but at this point the next objective short entry is a move back down below that recent low. That will most likely open the door for the next leg down, take us down to about 306 before the next reaction. And of course, if and I'm speaking to my positioning, if you are bullish, then what you do, or what I might consider if I was bullish, is I certainly wouldn't be buying below 312. I would not. I would be more concerned about where to stop out. Now, as a short, I'm more concerned about where to stop out if I'm wrong. We start going up here. And to me, it's, kind of fly by wire during earnings season, because you're going to get that volatility. You got to give it a little more room or they shake you out. That's my experience. And I will just say, if you're going into earnings season heavy long or heavy short, you're going to at the very least have some sleepless nights. So we'll know in a couple of days. We've now checked off, we've checked off Microsoft, Tesla, Alphabet, and now Meta. So tomorrow is Amazon. That's a big one. And then next week is Apple. And after that, again, I think this market will have chosen a direction. And being that Apple's all the way out till Thursday, My guess is this market will start to pick a direction heading into the weekend or early next week, um, regardless of what Apple does. And by the way, it's not all about the big FAANG's earnings. That is, to me, the biggest potential impact on the market for known uh, variables. In other words, those earnings are pre-scheduled. They happen every quarter. We know when they're going to be. But there are, there are plenty of other catalysts that can either foil the bearish scenario, the bearish outlook, or build on it. And that is, cracks in the financial system, muni bond market. I'm watching a lot of different things out there, and I still think it's that analogy of the Fed trying to plug a dam with all their fingers, and they don't have many fingers left. So we'll see. All right. Anyways, just wanted to say that's it. I didn't want to beat a dead horse. Breakdown, back test to the bottom of the range, rejection off that downtrend line, and there we are. So we'll see. Will we pick it up tomorrow? We'll see what Meta does and how much it carries through to the other big tech stocks. I just gave you a minute ago Apple. Let me give you NQ. NQ NASDAQ 100. This is the same 60-minute chart I got out to you this morning, and I've been posting lately. There's the big support level. Box it in like this. There's our trading range right there, which yesterday broke out. I broke down, gave us a sell signal, hit almost to the button. My 12, that was the first target that I've had on this chart for a while. 12, 8, 11-ish, bounced, and there it is. We back tested. That was that objective short re-entry this morning, and like I said, if we carried up to the downtrend line, that would also provide an objective short entry, which you did. You got there, and so we're still below that, and we're right back at the bottom of the range. So not to sound like a broken record, this is still an objective shorting opportunity for NQ. Sooner or later, if I'm correct, once this market decides that it's breakdown, once it becomes clear to the masses this is stuck, the breakdown, and that will be again a break below yesterday's lows. So an NQ, a break under about 12,800, let's say, to be safe, should send us down to the next target or targets. And then again, if that happens, and then at that point, I think we'll start to really snowball, and the selling will begin to accelerate. Again, that's just going from my experience how these trading ranges, that energy building like a coiled spring, and it can go the other way, so respect that. I'm sitting here and I've been unwaveringly bearish and short for weeks now, and but I've done this long enough that I don't get emotionally attached to any trade, and I'll throw it away if we start doing this. But as of now, there's not a hard level, because as I said, if we have a whipsaw here and then run up to the top of the range and pop the top of the range, we're still going to have negative divergence. We're going to have it here on the 60-minute chart. We're going to have it on the more important daily chart of QQQ, very much so. Any new marginal new high anytime soon will still be a divergent high, and on the even more significant weekly time frame, which I don't, everything's kind of turned off here. Nope, take that back. On the weekly, we don't have the divergence. That's something that you rarely ever see on a weekly time frame. Those are your trend changes. Bull and bear markets, tops and bottoms usually come with positive or negative divergence on the weekly. Once you get onto the bear, then you look at the trend indicator. You look for bearish and bullish PPO crossovers, and then you also look to see the posture of the PPO signal line, whether it's above the zero line or below. And these below boxes denote corrections in bear markets. You can go back as long as you want and see that's when you are in a bear market, when you're below. And add to that is that yellow line, which I have at about 1.56. Again, don't look at this one. Clear that. Let's dim that down a little bit just for right now. Look at the white line, because that's the last of the two to cross, and that 1.5 level, a little bit above the zero line, acts as support when tested from above. And in a bear market, remember, we haven't had, in my opinion, a bear market since 2007 to 2009. That was the last real bear market. Everything, even including the 36% drop in the S&P 500 when COVID hit, to me was just a correction back to the long-term, a lot of the long-term uptrend lines. So we are in most likely a larger bear market with more downside to come. So anyways, those are the levels to watch. Just want to let you know nothing has changed, and if anything, like I said, I think the bounce back today, the back test was and will prove to be an objective short entry. And like anything else, it is or it isn't. So you set your stops, accordingly based on your average cost, and very much so your price target. Like I said, I've expect nothing less than a 20% drop. I think we're going to get about a 30% drop coming up in QQQ on the next leg down, and that may or may not happen. But if it does, then that's helping. For me, it helps me formulate how much room I'm willing to give my swing and trend positions on stop losses. So like I said, it would take nothing is going to happen today or tomorrow is going to change my outlook. But let me say this. Let me add this too. One thing I wouldn't be doing, no matter what, forget about my positioning, whether I had my share of shorts or not. I wouldn't be adding if we go out now. We've already back tested that trend line today, or that downtrend, minor downtrend line. If we start going up, here's a midpoint of the range, that's resistance as well, and we start going up here, this I would not be adding to shorts, because that would, well, now we have a false breakdown and we're starting to move up into the range. That means they're probably going to run at the top and probably even pop the top of the range if they do that. So at that point I would hold off, sit tight, and I'll let you know if there's another opportunity, which would probably come on a upside pop of the range, depending on what I see, suspecting that will be a false breakout. But we're getting 5 steps ahead of ourselves right now. As of today, just know that we closed below there. You had objective short ops yesterday on the breakdown, today on the back test of the bottom of the range as well as the downtrend line. And then again, once we failed it, so even if you wanted to hold off, you were a little skeptical, you thought they might continue to run it, you saw the rejection. Now we're back below the bottom of the range, below that 312 level. But of course, turn back on the regular or the after hour trades, and we're right back to the trend line. But we're zigzagging down, lower highs so far, right there, and lower lows. So that's all the makings of a near-term downtrend line, and that's why I think yesterday's low is so significant. I think there should be. I'll tell you, if I was a bull and I went low, I would have stops. If I was active trading, keeping stops tight, I'd have stops there. I can guarantee you there's a cluster of stops not too far south of yesterday's lows. So again, it's a big if, but that's what the bears need to do. Take that out. And then that should, send us down. There's a gap right there. If you're looking just for short-term targets, you can see this big old gap. It'll probably come down there, backfill that gap, and so forth and so on. All right, so that's QQQ. SPY, we're pushing it right there. I thought we'd get it today, and they came in and stick saved it. That's that 406 level right there. Actually, then we went on to break it, I should say. We were testing that level right when I got that post out to you earlier today. Big level for me. Remember, I gave you back here this wedge out was sell signal 1 on the break of that primary, the white uptrend line, back tested on a few 60-minute candles there intraday, went down, boom. Took out the S2, the second, or the yellow secondary of what I call benefit of the doubt trend line. So sell signal number 2, and then today was sell signal number 3 on the break below. They tried one last attempt to hold 406, but you can see we closed solidly below it today. We gave up the 406 level. The SPY did, SPY. And close right on that first 404.19 support. Remember that white candle I'm showing you there? That's the after hours. This is regular sessions. That's how we closed the day. So that is a check mark for the next sell signal on the S&P 500, and that's that. Let's keep the video short and just conclude it with Amazon, since they're going to post tomorrow, and that'll be the last of the biggest or the biggest earnings report left in the week. When I say the biggest, meaning potential to move the market more than any other stock because of its weighting in both the NASDAQ and the S&P 500. Amazon makes up, as of April 10th, 6.2% of the returns of QQQ. This one single stock. Remember, there's 100 companies in the NASDAQ 100, and just this one, who isn't even the top holding, makes up 6.2%. I think it's like the fourth largest. Anywho, that's a big significant number. And that one did, the bear market downtrend line is really, it may end up forming if Amazon could rally, and I could see that possibility. You would have a trend line here because there was your high. That was it. That was when the market or Amazon peaked. I don't know why that divergence line should have stopped right there. That was our all-time high. Was pretty much a double top in Amazon right there. Divergent high 1, 2, and then that one did the trick and set the stock down lower. And so again, you can draw. I'll just put it here and then I'll lighten it up later. If Amazon happens to get some traction after earnings. Now, I will say this. Amazon is not going to go on and hit that trend line without the stock market going up. Just keep that in mind. That's why I keep trying to impress upon the importance of trading right now with earnings if you have more than your comfort level. If you're not sleeping at night because of how many longs or shorts you have, the old saying goes, sell down to the point at which you can sleep at night. And that's very important during earnings season. Now, if I turn off all these fancy lines and just look at the moving averages, Amazon has done a phenomenal job. Or the 200-day moving averages, that's the red line is the exponential and the blue line is a simple. Exponential just responds a little faster to prices, and they have done both historically and even recently in recent years a bang-up job. It's pretty simple stuff. When you're above the 200s, the trend's bullish. You're in a bull market. You want to buy pullbacks to the 200s. And it's, sometimes they'll go through there a little bit, but not much. And boom, boom, boom. Support, 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 support. And then one day that support was broken. That came right after that divergent high and right after the trend line breaks, sell signals. And since then, every single rally back to the 200 days, including recently, has capped it. So this is, that's a key level. And does one day mean that we no, because you popped it here for about a day and a half, intraday break there. But the further you get away from there, the further you chip away at the bearish case. It's not, again, I always say it's not binary, it's not all or none. If you're trading above, be long and full of Amazon. But these are the things to look for. And if you want to keep it very simple and not overthink things, be mechanical in a bear market. Don't listen to the noise on TV and every analyst. Use a simple strategy where if you short rallies into the 200, and then you can cover somewhat above is up to you. Again, if I'm right and the market's going to drop another 30%, Amazon's probably going down 20-30%, and I'm talking about QQQ dropping another 30%. Probably the S&P as well. I think there's enough mess with the banks. Remember back in the financial crisis, 2007 to 2009, both the S&P 500 and the NASDAQ both fell about 55% from the highs in that bear market. And that was and that's unusual. Usually the S&P will hold up more because you have your steady Eddie dividend paying blue chip stocks. And QQQ is higher growth, and that works great in 90% of the time because the economy is growing, the stock market's going up. But that 10% of the time or whatever it is, the stock market's not going down, tech tends to fall harder. But back then we had a financial crisis, hence the banking sector, was the big drag on the S&P that took the S&P down as much as the tech-heavy NASDAQ. And we have a banking crisis now, and not just banking. It's really, there's a whole shadow banking system they say could be just as big or bigger that has grown massive in recent years. They're not regulated. Those are insurance companies and other financial institutions that act as proxy lenders, and but they're not regulated like the banks. And there's just a ton of money in there. And they're again, heck, the banks are heavily regulated, but it's run by a bunch of buffoons. The Fed has lost all credibility. Any shred of credibility the Fed had a few months ago after not just missing the inflation trade, but being in complete denial, talking about it being transitory, and then finally doing the hard 180, raising rates too fast, breaking the system. But then I think the straw that broke the camel's back, if there's anybody out there that's a fan of the Fed, the fact that they completely missed Silicon Valley Bank. It is their job to regulate the banks, and they had no clue. And then, this wasn't just Silicon Valley, it's been ripple effects. Credit Suisse is gone. Obviously, that's not the Fed's problem, but yeah, the Credit Suisse had arms in the U.S. Anywho, that's so the point being, if we do drop down another 30%, Amazon's probably going to go on down to, if the stock market drops 30%. Oh, there's that long-term trend line right there. So that would be, let me just measure it out for you. This is my weekly chart on Amazon. And then I'm going to wrap it up here. Again, I just want to cover these because this is really where we'll see. So if Amazon, and really from the look of this chart, other than the 200s, if I turn that off and don't look at that, just like Facebook or Meta after earnings, I put 50-50 whether it's going to pop up there. And what does that mean if it does? Well, we're at 105 right now, roughly, is where we closed the day. That is only about 6.7% higher. And then that would hit, you can see it here again. There's your all-time high. Couple more reactions there, couple reactions there, and so that is what I see as the maximum upside for Amazon. Would I go long for that? Absolutely not. It's like picking up nickels in front of a steamroller. Does that guarantee if we go there that's all we go? No, we could go higher, but we could also turn around and never even make it there. The stock's in a bear market, and it's also at the 200-day moving averages, and so anyways, that's my take on Amazon. It had one of the most bullish charts. This was one of my favorite stocks off the January lows. One of my top positions, and caught most but not all of that rally, and that's it. It was a very bullish chart, but you can see what happened. This is a bear market stuff. Bullish divergences will play out. They just typically don't play out for the amount of, in a bull market, and you get a divergent low on the daily. That is almost always the catalyst for a move to new highs. In a bear market, it's good for a bear market rally. A bear market rally in a tech stocks, measured well into the double digits. You don't even bother, if you're looking for a 5-6%. No. When you get a divergent low and bullish technicals and the stock holding long-term support, yeah, you're going to have a double-digit move, on that, and that's what we had. So let me wrap it up here. Again, Meta is going to do what it does, and then they're going to, the market will kind of figure out which way it wants to go tomorrow. All I can tell you is it is at, as I started the video, very good resistance, and it's actually one of my favorite for the individual FAANGs. Now earnings out of the way, and so if I liked it last week, gotta love it now with this here. Go back to that, turn on those after hour trades, post market right there. Colors on the daily, it's coloring up green. I gotta change that, so that should be that white candle. But all right, that's it, guys. So let's pick it up. Like I said, sell signals are still intact. It's not an all-in moment yet. You still have a couple more FAANGs out, and the Qs are really trying to hold that. They're back testing. Like I said, I think the odds go up substantially if and when QQQ takes out yesterday's low, and then SPY. Remember, SPY just made a new lower low today, so obviously you want to see that get taken out too. And that's where we're at. We start going the other way, I will communicate my thoughts as soon as possible, but I can tell you 1-2% update tomorrow wouldn't change my longer term outlook. Might change my very, very near term outlook, but I'll communicate my thoughts at the time. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.